Joining us is Morgan Stanley's Chief U.S. Equity Strategist and Chief Investment Officer, Mike Wilson. Mike, always good to have you, particularly on a morning like this one where your call may be responsible for at least part of this rally. But looking deeper into your piece from this morning, I am stopped when you say, to be crystal clear, we think a tradable bear market rally began last Thursday. However, we also believe the 200-week moving average will eventually give way, like it typically does when earnings forecasts fall by more than 20%. So you're still not long-term bullish.
Well, by the way, thanks for having me. We're long-term bullish, but long-term is in the eye of the beholder. In fact, one thing maybe I'll start out by saying is we've been obviously more bearish than most this whole year, but I would say we're starting to get to a point where, our intermediate-term view is probably more constructive. Let me just spend a minute on that. That'll explain some of the reason for this tactical call. But first of all, we do not think this is the 1970s. We do not think this is a cost push inflation. It's a demand pull inflation. It's very serious. We actually called for that back in 2020. It played out in a positive way initially with earnings, being the beneficiary of that, stocks also benefiting from that. But now we're in a bust, and that bust is not fully played out. So, yes, we think the earnings recession and probably an economic recession at some point will play through, and that's not fully priced. However, the room has gotten crowded, and we don't tend to trade against our core view too frequently, but we felt like this is a good chance to do that. We've had a bearish view for all year. We think the 200-week moving average is a really important technical level that a lot of people don't talk about. We felt like that would be touched maybe in June. We didn't get there, which is one of the reasons we didn't turn bullish for that rally, which turned out to be very powerful. But this one is the same idea. The bear market is not over, but you can have major moves off of these technical support levels, and that's the world we've been in. It's technicals versus the fundamentals, and so we got to play it both ways. We can't get too dogmatic in our views. We've been bearish all year, and it's time for some relief.
Understood. But again, to make it clear, though, your view of overall earnings and the resultant discount, or I should say reduction perhaps in the multiple or simply in the market as a result of that remains, correct?
That's correct. So we haven't seen the things that we need to see to call the end to this bear market, which is fundamentally driven, right? We overheated. The Fed reacted to that. Financial conditions are tightening, and now we're going to feel the effects of that on growth mostly next year. And the good news is the market is discounted, I would say, almost 100% of what the Fed's done at this point. And I would say they've discounted very little of the earnings impact that's going to be felt next year. But in the middle of that transition, you can have these periods where stocks can dream about, hey, maybe we aren't going to get that growth effect, and rates start coming down for technical reasons and fundamental reasons, right? 4% 10-year is pricing a lot of what the Fed is still to do. And the UK situation, which I think was probably responsible for the last 50 basis points of this move, is now maybe turning the other direction. So you have rate support potentially that could get into stock prices in the short term before it becomes crystal clear that our call for earnings is really playing out. That may take until the January, February reporting season.
Your point about fundamental reasons for rates to come down is interesting. On Friday, I think it was Ellen Zentner put out a chart of your view, the House view of core PCE really returning to the twos by the middle of next year on a 6-month annualized basis. I wonder what you think that environment's going to feel like. Will we have Fed funds above inflation? And how do you keep the bulls from really rocketing even higher than your call says?
Well, that's right, Carl. So I think the market will feel pretty good about that when it's happening. Now, let's make no mistake about it, okay? Last week's inflationary numbers are still way too high. And so that decline that Ellen's looking for, okay, is not going to happen in the next 3 months. However, markets are forward thinking, just like they are in the equity market. And so we think that could start to get into the rates market. We're not calling for rates to fall down, but maybe they just stop going up. That can be enough for, once again, equity markets to get excited. Unfortunately, I don't think we can avoid, okay, this earnings recession that is coming next year, because at this point, the Fed's already done enough to create that, in addition to the natural ebbing and flowing of the earnings cycle on its own.